welcome back to the Coinist Podcast. It's been 2 weeks. This is the longest we've gone without an episode in a while. It's good to be back. Hopefully you guys haven't unsubscribed or forgot about the show because we're back. I'm bringing you a panel from Blockchain Week. So if you're sitting in your car, if you're on your way to work, if you're having a beer on your couch, wherever the hell you are, you get to get some of the insights and hear some perspectives from some guests from Blockchain Week, right? Some speakers from Blockchain Week. Invited out to San Francisco by the Compound Finance team. Rob and Calvin put on an incredible event. Compound, thank you so much for having me. And they asked me to moderate a panel. And at first I was like, well, I've never moderated a panel. I don't particularly like to do that kind of thing, but I figured if I could record it, pass it along to you guys, you get to hear from Nic Carter, Tom Lee, Marc Bhargava. Marc is the co-founder of Tagomi Systems. They're a prime brokerage for top funds like Pantera, so he sees a lot of the execution type things. You have Nic Carter, the co-founder of Coinmetrics. If you aren't familiar, you've probably seen their charts on Twitter before, you just didn't realize it. And then you have Tom Lee, head of research and co-founder at Fundstrat. They put out a ton of research, really good content on Twitter and elsewhere. He's on CNBC, Squawk Box a lot. He's on that talking Bitcoin, talking markets. So to get all the perspectives at once, I thought was a treat, and I thought I'd pass it along. I got to ask the questions that I was curious about, things like, can you actually attribute some of this move to China? Is that a sustainable move? Who are the sellers in this 2019 Bitcoin rally? Is there, what's the health of this bull trend look like? Is it still a bull trend? How many people are actually in Bitcoin? We talk about Libra and its implications in the market, a ton of different things. And I had all three of them to answer the questions. So this one's a lot of fun. The negative about this episode is I don't have a video. I couldn't get the video set up. So you're just going to be looking at a screen of their pictures, their beautiful faces, but no video today, guys, so I'm sorry. Still smash like, hit subscribe here on YouTube. If you want to listen to this one, since there is no video, I understand. The iTunes and Spotify link is down below. You should probably subscribe anyways. Sometimes it's easier to catch them on the go like that. For everyone that's tuning in again, happy to have you back. Happy to get these rolling again. I have a couple episodes coming up you're probably going to want to see. That's CZ from Binance is coming on. We're going to be talking about everything Binance, how they're now competing in that future space, what the future of Binance looks like. China's going to play a role there. Also having on Mark Lamb, CEO of CoinFlex. We're going to talk about how you and anyone that uses their platform can actually make money betting on whether Libra happens. I think that's going to be a fascinating topic. And even if you aren't a trader, understanding probabilities there and what the market's pricing in is probably going to be important for you as well. Enjoy speaking with Mark every single time I do. A lot of episodes. I still have Tom O'Shaughnessy, his episode, Delphi Digital. I have so much coming up for you guys. It's been 2 weeks, though. I've been on vacation. Like I said, I was at the Compound Finance thing, Blockchain Week in San Francisco, and I was also in Scotland for a week golfing with my dad and with my brother. We played St. Andrews. We played Kingsbarns. If you ever get a chance, if you like golf, get out there, have a whiskey, go play St. Andrews. You will not regret it. Try not to spend too much Bitcoin, but it's worth the trip, guys. Anyways, before we get into today's episode, I'm rambling. You guys are really going to enjoy this panel. At least I hope you do. I learned a ton. But before we get into that, have to have a word from our sponsors. This podcast is brought to you by eToro, the official sponsor of the Coinist Podcast. If you have not signed up there, especially if you're based in the U.S., we just launched CopyTrader in the U.S. Click the link right down below. Sign up on eToro. Check it out. Massive new features. No exchanges offer this yet in crypto. Right, there was one a while back, but this is a regulated exchange. If you're in the U.S., click on that link. You can screen through all the traders. Right to the right of my head, you can see a little walk through the platform. You can trade any asset that you're familiar with, Bitcoin, XRP, Tron, ETH, all those. You can buy them. You can visualize how your portfolio is doing. You can screen the top traders. So the copy trader feature is what everyone's talking about. Go through all the traders trading on there. You can see what they're holding, what their positions are if you want to look at it that way. Or you can click copy. And what that does, every single time they make a trade, you make a trade with them. You don't have to be in front of your computer. You can decide how much risk, or let's say every single trade they make on Bitcoin, you only have 5% goes towards that, right? So there's all these different ways you can do that. You can visualize the best traders, copy their trades while you're watching sports, while you're watching football, while you're at work. All that gets handled on the eToro platform, regulated platform in the U.S. I am always excited to work with any company in crypto that is helping give U.S. traders an option where a lot of other exchanges have blocked them out. Right, so eToro, I am thrilled to be bringing you guys all their announcements. You can still see the platform over here to my right. You can see your portfolio, all the statistics. It's very advanced, also very easy to use. Right, they've been around for a long time, but now just moving to the U.S. and also bringing that copy trader feature, you guys are going to love it. I'm going to be on that platform soon, so you can look out for me. All that info is right down below. Get signed up. If you're in the US, you have to sign up right now. Thank me later for that one. eToro, excited to be working with those guys. Also, I have a word from Bybit, who's been with me since the beginning, making this possible. If you guys haven't checked out Bybit Exchange, I imagine most of you have. For everyone in the US, check out eToro. If you want to trade derivatives, though, check out Bybit, the easiest to use derivatives platform with no overload. So I know some exchanges have overload. You click your order. Let's say we're moving from 7,500 up to 10.6. It happened a week or two ago. You can't get your order filled. That does not happen on Bybit. No overload. Incredibly easy to use. They have contracts like XRP, perpetual swap, Bitcoin perpetual swap, so you can long or short those things. Be hedged, trade both directions. Very easy to use. Constantly impressed with Bybit. Great customer support, and they've climbed the ranks to be in the top 5 derivative platform very quickly. Right? So I love what they're doing. I want to continue to help them do what they're doing. And as they continue to solve the problems that traders were having in that derivative space, check out Bybit. All that info is down below. They also have a trading competition coming up. So if you want to win 100 Bitcoins, I think it's 100 Bitcoins. It's a lot of Bitcoins, whatever it is. Check out Bybit. It's going to be a pretty fun trading competition. Thank you, Bybit. Thank you, eToro. Without further ado, guys, let's get into the show. Hope you enjoy the panel. I had fun asking the questions. Enjoy.
Ladies and gentlemen, it's time!
You are listening to the Coinist Podcast.
So like Robert said, we'll be doing crypto market perspectives. I'm joined by Nic Carter, partner at Castle Island Ventures, co-founder of Coinmetrics. Come on up. Also joined to my right by Marc Bhargava, co-founder of Tagomi Systems, and Tom Lee, co-founder, head of research at Fundstrat. And what I'm going to do before we dive into any discussion, I'm going to have them kind of give an intro, what they focus on most, what their firm specializes in. It'll give some context to what we're going to talk about. So start with you, Marc.
Yeah, sure. Thanks for having me. Started off more on the investing side, so I'm a seed investor in Blockstack and Algorand, Filecoin, Zeppelin, but switched over to the operating side to team up with Jen and Greg, and I'm co-founder at Tagomi Systems. We're electronic brokerage, so a lot of clients in the audience, really helping clients get best execution and doing things like lending, shorting, margin, all in a more automated, technical, agency way.
Tom, Fundstrat.
Yeah, I'm co-founder of Fundstrat Global Advisors. It's a independent research advisory consulting firm. Celebrated our 5th anniversary just a couple months ago, so we survived the mortality statistics. Our focus is primarily on asset allocation and macro strategy, but the way we do it is through demographic work, studying growth and adoption cycles, and that led us to crypto. I think it's one of the most important industry drivers, and actually one of the biggest GDP drivers. I mean, China basically validated that thesis.
Go ahead.
Hi, I'm Nic Carter. I'm a partner at Castle Island Ventures, a Boston-based venture firm that invests in startups building on top of public blockchains like Bitcoin and Ethereum. I'm also the co-founder of Coinmetrics, which is a blockchain analytics business which seeks to understand and characterize the economic activity happening on every blockchain.
Cool. All right. So how I wanted to structure this was where we are now from 2019 to now, all the craziness that's happening of late with China, all the news that continues to come out, and also where we're going. Maybe not 2025, but 2020, 2021, what themes are going to be important there. 2019 kicked off, Bitcoin's up 3x, nearly still. I'm going to start with you, Nic. Libra has been a big story, but I want to focus on Bitcoin first and something you've written about, realized cap. So price-wise, we haven't hit a new all-time high, but this year, realized cap hit an all-time high. What does that tell you about the entire crypto asset industry this year, specifically Bitcoin?
Sure. So for those of you unfamiliar, realized cap is this idea that we can exploit the transparency of Bitcoin to devise a metric which is maybe more informative than just straight market cap. So market cap you get by multiplying, the price by just the aggregate number of units ever issued. The intuition behind realized cap is that we want to price all of the units of Bitcoin according to their market price when they last changed hands. So you assess the market price of each UTXO according to the price when they last traded on-chain. And so realized cap is at an all-time high for Bitcoin right now. And the way we interpret that is to mean that Bitcoin holders have a higher cost basis for Bitcoin than they ever have historically. And realized cap is at least 30% below the price right now. So your average Bitcoin holder is in profit right now. So interpret that as you will. The idea really is that a lot of people look at the collapse in price from 20,000 to where we are today and think that your average Bitcoin holder is actually suffering or under duress. But in fact, very few Bitcoins actually changed hands at the north of 15,000 range. So this is just a way to more quantitatively assess the health of the average holder. And for the most part, they're feeling pretty good right now. And my guess is that that would trickle over into other coins as Bitcoiners try and diversify, we saw in previous cycles.
Yeah, definitely. So one more thing there. Even with the recent sell-off in September, right, the breakdown from 9K, which was pretty violent, where were people buying there? Because you can actually look at where those coins traded hands. Who were the sellers there? Was it longer-term holders looking to get out on a cycle, or was it the short-term traders that have stepped in and panicked a little bit?
You're putting me on the spot here, actually.
No, we'll go down.
I wish I had the chart in front of me. But, that's the amazing thing about these assets is you can evaluate, different cohorts and see what precisely people are doing. And I think it enables you and will enable you to mitigate risk and just understand where the risk in the system is present. I mean, that's, one of the most interesting things about the on-chain lending protocols like Compound too, that, all those like liquidation thresholds and in Maker as well are known. So there's something really beautiful about crypto finance, the fact that it's so on-chain and present and available.
Tom, switching it up a little bit from something so nerdy as on-chain metrics, we're going to go, you focus a lot on global markets as well, not just Bitcoin, in addition to Bitcoin. What was the environment like in Q1 2019? Because something changed. Beginning of the year, we were talking a lot about trade wars. Market wasn't so optimistic. We've slowly transitioned into a lot more optimism. Can you kind of talk about 2019, beginning of 2019 to now, how you paint that picture on how that relates to Bitcoin as well?
Yes, thanks. It's, 2019, if we were just thinking about the numbers, S&P's up 22% year to date, which is the best year to date performance since 1994. I mean, so unless you're over 25 years old, you've never seen an equity market this good. And yet, as you know, at the start of this year, if you asked the average fund manager or the average talking head or even just your neighbor, they would have said, batten down the hatches, get some bottled water because trade war, negative rates, the Fed, yield curve, you name it, people were super bearish. And I think it's just a reminder, especially because people, when they look at public markets and they see it populated by professionals, they always think the pros get it right. Consensus is almost always wrong. I mean, that's what you have to remember. When you feel something so strongly, like, hey, we're a recession starting, and then you have it confirmed by everybody on TV, that's already been priced in. So I think that this year is a real reminder that people, we tell our clients, people carry a 2008 hammer, and they're looking for 2008 nails. I think people are looking for a crisis. And our clients are pretty happy with us because at the start of this year, we told them that 2019 would look a lot like 2009. We were convinced that this year would look a lot like the start of a new bull market. And I guess the perspective I have is, it's just a reminder, the pros, as smart as they are, they're more concerned about keeping their job. And how do they keep their job? They stay in the middle of the fairway. Nobody who manages money wants to take a contrarian, stick their neck out view because that's not how they keep their job. Incidentally, that's not how CEOs keep their job. Remember, the average CEO's pay is $20 million a year. If you got paid that much money, you would do everything to keep your job. And how do you keep your job? Just say what everybody else is saying. So CEOs never know the future. And I think that's why, in crypto, which I think has a lot of outliers and a lot of people who think the world's messed up, your views are, there is no consensus in crypto. I mean, right? I mean, everyone's, an insurgent. And I think that's why when you look at Bitcoin, it tends to be what the consensus is seeing is actually correct. I think crypto trades the opposite of traditional markets.
So I think kind of this Bitcoin bull market, I think, is actually a lot more nuanced. So if you look at the actual volumes that are trading across exchanges or OTCs or brokerages, I think it's still much lower than you saw at the end of 2017. And so much of this run-up has been done generally on lower volumes. And folks like Bitwise have done really great work, a client of ours, kind of describing some of that. I think what you saw at the beginning of the year was kind of two stories, one in the US and one in Asia, which pushed up prices, or at least what we saw internally. So here in the US, it's a lot of the same players, like large crypto funds, people who bought in really early, sort of in that old Zappo crowd. And then in Asia, you saw a lot of doubling down by miners, actually, at lower pricing, and some of the really large consolidated miners placing buy orders. So all of this is sort of the existing crypto world that in many ways have pushed these prices up over the last 6 to 9 months, and you kind of see the reflection of that in that the volume numbers haven't increased significantly. So I think it has helped a lot of people come back to the drawing board now, looking at more family office, venture, asset managers, and others, but many of them are very, very early on. I would say if you think about who are the new entrants or new players that are driving volume that you might not have seen in 2017, there is one group that we're seeing quite a lot of now at Tagomi, which is more two-sided quant funds that go both long and short. And so the ability to actually short more mature futures markets, you are starting to see some market neutral, larger name quant funds and hedge funds that are more traditional come to the space. But overall, I think you're still very much in a bear market where it's primarily the believers who are doubling down on quite low volumes. But I mean, I'm very obviously optimistic, and that's why I'm risking my career on the idea that that's going to change and you're going to see new entrants, and we are starting to see that. But I think, at least we don't view it as a bull market.
Sure. I think we all hope for that. Tom, you've spoke to this as well, that there's maybe an overstatement of how many people are participating in this. And you said, just like Mark did, it's a way fewer number of participants.
Yeah, I mean, I'd concur with, with Mark's view that, Bitcoin price rise has been mostly dry powder. People who sold and been putting money to work. And in fact, I think the crypto market in terms of actual active users has contracted dramatically. So we, through a variety of methods, you guys can do your own work on this too. I think there's less than 500,000 holders of Bitcoin today. I think it's a lot smaller than the estimates you've seen in the millions or 50 million. And I'm not saying it to sound bearish. I think it's actually really a bullish observation because I think very few people are really responsible for setting the price today of crypto. And if network value, which I believe is still a driver, if network value is still a factor, if you take 500,000 back to 5 million, that's all, that could be 100x in price, even though it's a 10x in engagement. So I think it's actually quite bullish.
Nick, any thoughts there?
Yeah, it's a challenging one to estimate, but in the estimates I've done where, for instance, you take the known balances of Coinbase and you take the known user count for Coinbase, then you back out what your average exchange holder might be holding in Bitcoin, and then you take other known balances at other exchanges and custodians, and then you sort of naively interpolate. You can get a figure of something like 30 million Bitcoin holders. Certainly they're not all on-chain holders. If you look on-chain, there's probably 10 million or so addresses with a meaningful balance of Bitcoin. And obviously an address doesn't map to a human, for sure.
Yeah.
So, I would say my guess is of at least passive holder stock is definitely in the tens of millions.
Yeah, I mean, just, again, I'm not going to say I'll just make some observations, but, just take Twitter. You take any millennial, and Twitter's the smallest of any of the social media platforms, but you take Taylor Swift or Katy Perry, and they have 118 million followers. Okay, and so you'd say, okay, well, for millennials, music, that's the size of the market. If you look at crypto Twitter, the person with the largest following is John McAfee. Okay, and he has like just over 1 million followers. That tells you that crypto Twitter, with the most popular person, is less than 1% the size of Katy Perry. So, I mean, to me, if crypto was 30 million, there should be a lot of guys in crypto that have 5 million, 10 million followers.
So I think that's a really roundabout way of estimating it.
No, I have others. I'm sorry.
So I think the best way is, so there's an entity in Europe called NXMH. It acquired Bitstamp, it acquired Corbit, it diligenced most of the major exchanges in the US, and we got lucky enough for it to be an early investor in Tagomi as well. And I think kind of the way Nic mentioned it makes sense, that you can go exchange by exchange. People who have gone through diligences of many of these exchanges can actually see there are definitely a lot of inactive accounts. To Nic's earlier point, there are accounts that have almost no Bitcoin in it. Sometimes it was just the exchange gifting it to people to try to get them to engage with the account. But you can take a pretty healthy haircut there and be, I think, pretty confident that there are at least 5 to 10 million unique people in the world who own 0.1 Bitcoin or an account like that. I think, though, the really exciting part is that what's coming next. And that's much more around this narrative of Bitcoin as a global hedge. Nobody really believes it except for the Bitcoin people. But it is it's a really good thesis. And so you're sort of early on into testing this thesis, which, to date, I don't really see the correlations proving. I don't actually think that people moving markets, you talk to like Wellington or Citadel or these larger spots, like our COO came from Citadel, and before that, I was senior at 2 Sigma. These people are not really thinking about crypto or Bitcoin as a hedge in any way for the global economy, but I think that's what's so exciting about it, that it's obviously incredibly early, and it's a thesis that might be adopted in small communities, but there's a broad way to go, and I think that's the exciting part of the space.
By the way, I'm giving roundabout info because I don't know who's in this room, and so I don't like to share unless you're a paying client of mine, the source of my data. But just remember, we usually have some insights that people get very angry at us about. But look, I've been doing it for 27 years. I'm not making up a number. I think that the definition of how people are defining holder of Bitcoin is, we're saying that they've actively traded it or used it in the last 12 months. It's a lot smaller than people realize.
All right. Regardless of how many people are in Bitcoin, because we could debate that all night, Marc, what you brought up as Bitcoin potentially acting as that hedge, right, a systemic hedge. Tom, that kind of goes directly against Bitcoin is, as equities rise and as equities rally, you're kind of getting exciting there, thinking that Bitcoin could follow up. When it's risk on, Bitcoin is probably furthest up the totem pole in terms of risk assets, so some money should flow there. Versus beginning of the year, everyone was saying this is a safe haven trade, gold's going up, Bitcoin's going to do well as well. It's uncorrelated to everything over a timeline longer than a year. What are your thoughts there, Tom, on can it be a safe haven trade and can it also be a risk on play?
Yeah. I agree with Mark's statement that, long term, Bitcoin's uncorrelated to the stock market. It's uncorrelated to GDP because, remember, Bitcoin is a network value asset. It's really, you take it from 500,000 to 5 million people, it's a 10x, it's a 100x price. It had nothing to do with how GDP did or with what the S&P PE did or with what the Fed's doing. So I think its future is completely uncorrelated. However, there are some strange coincidences that people don't like to hear, but Bitcoin's best years, if you look at the years where you made all your money in Bitcoin, in the last 10 years, they've all been years when the S&P is up more than 15%. Bitcoin, when the S&P's been down, Bitcoin has had down years. They move in the same direction. It's a very unpopular opinion, but I think it's very explainable. It's just saying if the U.S. plays an inordinate role in day-to-day movement, and it's a retail market, people are trading Bitcoin as a risk-on asset. And that's just the nature of it today because I think it's a freakishly small universe of holders. I'll tell you, we have over 4,000 portfolio managers that receive our work, And we circle the wagons. We've had to because, it's been a really scary environment for our clients. So we've been touching base with a lot of people. I wouldn't even say 1% own Bitcoin. I mean, they're not playing, and if they do, they're playing with Coinbase. And seriously, it's instead of giving the $200 to their kid for allowance, they're buying Bitcoin. They're buying it there are some guys buying it in size, but it's a tiny, tiny, tiny universe. And I think, if that's, the financial world, you can imagine the retail world, no one's buying Bitcoin in size with conviction unless they think the markets are going up and they have money in their margin account. So I think that's the only reason. But it's going to change. I mean, the future has nothing to do with stock market.
Yeah, I think I can add a little bit of color on that. So being associated with a data business that sells essentially macroeconomic data in crypto, you get some interesting metadata in terms of the clients that are interested in that. So I guess similar to Tom's experience, but in 2019, the people that have been asking us, how do you value Bitcoin? How do you value crypto assets generally? A lot of them have been just global macro, conventional hedge funds, not industry entities at all. In some cases, global investment banks that are trying to build a perspective on how you could possibly even think about valuing a crypto asset and what, network usage metrics might vary with the price. And I think there's just going to be a natural, maybe 3 to 4 year prelude period where there are commodities analysts get their teeth around something like Bitcoin and, begin to feel that they might have an edge or at least, a coherent thesis and how it might be treated, understood, and valued. So, we didn't see that in 2017 at all. So I think something is a little different now in that it's just being taken more seriously as an asset class. And maybe the fact that some of the utopianism and froth has subsided is actually pretty good because, those of us that are left in the industry maybe look a little bit more sensible by comparison. So generally speaking, I think we're just in a quiet period where people are taking the last 11 years of data, which is abundantly available, and are beginning to try and build it into a coherent framework. Unfortunately, the most popular model to value Bitcoin is the stock to flow model, which I think is a little silly. But we're getting there. I think we'll have our Graham and Dodd moment soon, where some smart analyst comes along and says, okay, this is going to be your main valuation driver for a crypto asset.
In the meantime, while they're still trying to figure that out, right, trying to wrap their head around that perspective, Marc, your company is helping those newer investors try to gain that perspective, try to get in. As this financialization happens, are you seeing a company like yours, which focuses on execution but also handles custody and other things, are you seeing that give confidence to new investors, or is that just making it easier for your current clients? What's the mix there when things like Zappo and Coinbase team up? Is it actually new institutions coming in, or is it just the people who are already here saying, our job's easier, operational risks are lower?
Yeah, I really think it's a mix of both. So I like one of our largest investors is Peter Thiel's Founders Fund, and their 2013-14 thesis of how to think about Bitcoin I think is pretty good, which is it is a risk-on asset. So like Tom said, it really is correlated to a huge drive up in all sorts of asset valuations for private things and for tech in general. But it also has this call option on the world going to crap. So it has this call option on a huge currency war or war breaking out and everyone trying to devalue their currency. You're putting up political instability. So it's sort of this risk-on asset plus a call option on bad things happening in the world. And at least sometimes their view is that latter part will end up being valuable. I think what we're trying to do is focus both on what clients need today and what they'll need in the future. So today we're lucky enough to work with Paradigm and Multicoin and Pantera and Co-Ventures and just a lot of the really great funds in the space who've also decided to double down and invest in us and really build around what their trading needs are, which are much more sophisticated than a lot of people who are trading the market in 2017. But at the same time, my co-founder Greg ran Goldman for 13 years and sold 2 businesses, and we want to make sure the product is designed for the Wellingtons of the world. And so even though it's a very small % of our volume, we have RIAs on the platform, and whenever they request stuff, and it's normally like tax accounting, but we really go around our way to automate that, focus on the product. So I think the smartest projects, at least in the centralized space, are both building for the here and now, improving functionality, but definitely have to be thinking about, things are going to change. People are going to start asking for best execution. Brokerages are going to have to be separate than exchanges. You're going to need more robust settlement layers. You can't just rely on Silvergate and Signature and folks like that for fiat settlement, even though that's who we work with at Tagomi, for example, as well. So I think you kind of have to have an eye for there will be a totally different standard coming, but at the same time, really execute with the best and most savvy players in the space.
It makes sense. That sets the stage for where we are now. So that's 2019 to now, and I've been trying to avoid it. We're going to get to China, and I'm curious to hear Nic's perspective here. The recent price rise, I try not to focus too much on price. I know not everyone here is interested in price, but when it rises 42% in a day, that gets everyone's attention. A lot has been thought and said about what caused this price rise. Initially, Xi Jinping, the China statement, everyone was saying him supporting blockchain caused the rise in Bitcoin. I think the move happened 10 hours after. I saw that in the Coinmetrics chart. Nic, what are your thoughts there? And Tom, I'm going to ask you to weigh in there as well.
Yeah, so I looked at all the 12-hour periods in Bitcoin's history for as long as we have pricing data. And I think I've found that the 40% spike was something like a 9 standard deviation event, which I was telling to one of my quants, and he's like, if you have a 9 standard deviation event, you have a misspecified model. So, let that be a lesson to not model returns as a normal distribution. Don't do that. I don't really have an explanation, to be frank. As you know, I don't really buy the narrative that China making statements about blockchain is fundamentally good for Bitcoin or public blockchains. I see public blockchains as a tool of freedom and individual expression and empowerment, and to me that doesn't comport with what the Chinese regime is really is after. What might be bullish is if they became super draconian about capital controls or devaluing the yuan such that regular Chinese folks would really have a need to go to cryptocurrencies. But I'm not a trader, to be frank, so I don't necessarily have explanations for big price moves. I think it's important to also not demand an explanation when sometimes just the market catalyzes these things without meaning.
Certainly. Tom, any thoughts there? Even I'm not asking you to pin it on there, but any thoughts on whether or not it played a role or whether or not that should be completely ignored?
Yes, well, Nic and I both know the person that drove the price up 42%. We just can't reveal it. Just kidding. I agree with Nic, and as you know, Nic's probably, kind of been poking fun at the idea because he's been pointing to all these other headlines that occur around price moves. And I think that's true. Like, in asset markets, sometimes news coincides with an event, but that same event could have occurred, on a different day and nothing would have happened. So I think there is a tendency for us to correlate things that shouldn't happen. And I had a really great conversation with someone today who's considered the godfather of technical analysis. In fact, he was a patented, trademarked, the only trademark trading system out there today, and was originally on a exclusive system, and has been around since the 70s. So if you guys are historians, you would know who I'm talking about. And I had a nice conversation with him today, and he said that it was a predictable event Friday because it registered a number 9. So I think if you look at how markets were behaving into that, because I would say this guy is probably the best behavioral market technician. He's really good at sort of understanding where pain and thresholds and how markets behaving. It was almost to the minute that it happened. So I think in some ways, there was a lot of spooled energy that took place. But I guess I would throw this question out to Nic. Do you think it's signal? Does that 42% move mean anything, or do you think it's just an idiosyncratic, statistical event?
What it means to me is that traders think that the news is meaningful. I don't think it ensures that the news itself is signal, but certainly the market interpret it as such. Although I think there's a really significant risk if you're watching the markets and you're active and present in them, like we're active in the markets in terms of trying to decide which protocols we think are going to be the most robust and vibrant for years to come. But in our line of work, if you fixate on the short-term price moves, you risk incorporating all these like headlines and booms and busts into your analysis of what is still a software protocol. The fact that they have prices attached to them can really obfuscate the reality just by inundating you in a torrent of noise. So I actually do my best really not to look at the price that frequently. I might even only look at markets once a week or something.
Makes sense. Mark, you're going to get away from the reason it moved. It could be Kanye West's album. That was a popular one. But with a move that happens that quick, right? People think about Bitcoin as the most liquid asset. It is the most liquid asset in the crypto asset space. But still, it can be pretty thin on a move like that. I talked to CoinFlex CEO, a derivatives exchange in Hong Kong, and he was talking about just how crazy it was that morning. How is it for you during a move like that to Gomi? Are all your clients freaking out? Are you guys freaking out? What's the, is there execution problems still? What does that look like?
Yeah, there are definitely still a lot of execution problems. I think for trades above 5 to 10 million at once, we generally advise clients to use an algo, even if it's as simple as a time-weighted average price algo. So it definitely, like I said earlier, it's everything is still on low volumes. You do see volume spikes, obviously, when you see this, but you have to be really intelligent in this market because you can easily move it, and there are people also trying to move it on purpose between BitMEX and also certain exchanges that they target. So I think, it is really important to have best execution. For us and our clients, you're still within the range. So even though it went up, quite a lot, it was still, within a range that it's been sort of trading in the last month or two. So it wasn't that surprising there. I think kind of on the China news, what I'm really interested in is I think maybe that's the first announcement. If you know anything about like the Chinese Communist Party, they do things in a very methodical way, and there's always like several shoes that fall. For me, what would be interesting to see is how they will now interact with exchanges in China. So you have three main exchanges. You have Huobi, OKEX, and you have Binance. And OKEX started earliest. There's been a little bit of friction with the government there since the beginning, but it has grown, and it also operates actually a massive futures exchange. There's Huobi, which is sort of this kind of middle one, which I think the founder is a bit more liked by the Chinese government, but it still has been quite restricted in some ways in how it operates. And finally, there's Binance that's run by a Canadian and has moved really quickly, and the government probably likes out of the three the least. So I think what's very interesting now is, do the Chinese government, do they back another exchange that they own a part of, that they control more? Do they decide that the relationship with Huobi is strong enough to really let it operate more freely? Does it make a move now and say, certain exchanges can't operate, and it finally goes after Binance? So for me, I think the very interesting signal will be more what the government actually does, rather than this sort of wordy pronouncement about the wonders of blockchain, which, it's very hard to tell what that means.
Yeah, it is. Looking back on our soil over here, and less so much about short-term price movement, there was an article I read from The Block today talking about the backed consumer app launching, Starbucks being that first customer. I feel like I read this a year ago, but it just came out today. It's the same news. Are individuals using Bitcoin for small and legal payments? Does that matter so much, where the narrative and the investment case right now is digital store value? Kind of go down the line with this one. What are your thoughts there? Does that actually move the needle? Does that matter?
So I was thinking about this today, and the interesting thing about crypto is that you have final settlement and essentially a bearer asset, and so you get that immediacy with a payment, which is nice. And you contrast it to trying to send a wire with your bank or something, and by contrast to that, it's much better. But I think the truth is that combining the payments layer and the settlement layer, which are traditionally kept distinct in most payment systems, actually leads to a lot of problems, because then you force the users to do self-custody, they have to manage their keys. These are really significant risks, and we see the issues with them every single day. And you have no recourse if something goes wrong. These are all the critiques of cryptocurrencies that you hear from outsiders, but I was just reflecting on them today, and I think they're actually quite compelling. It's funny because, in crypto, we spent so long trying to build functional base layer payment systems, to make Bitcoin suitable for coffee payments or something. We realized that wouldn't work, and then we built all these deferred settlement systems like Lightning or side chains or Plasma, I would even characterize sharding as a deferred settlement system. That's precisely what happened in the traditional payment space. You have deferred settlement, you batch up a bunch of payments, and then you have a final settlement, that clears at the end of the day or something. So in a sense, we're just redoing what happened in payments. So I don't really ever think that final settlement is required for a small scale payment. I mean, what I think crypto is good for is like large scale, high assurance payments between mutually untrusting counterparties over a distance. That's radically new. We didn't really have that before. That's like being able to send a pallet full of cash but at no cost. That's amazing. I don't understand the fixation with small retail brick and mortar payments for crypto. So to me, the backed news is it's very puzzling to me that they're focusing on Starbucks. What they're doing with custody and fully integrated markets is very compelling, but the Starbucks thing is befuddling.
Tom, thoughts there, whether that's signal or noise?
Well, if you look at, the universe of people who don't own Bitcoin or think Bitcoin, doesn't make sense, they've studied it and they think it's dumb, or they don't think it works as money, one of the objections they bring up is can you use it every day and can you buy a cup of coffee with Starbucks? I mean, so it is a cliche. I think for the most part, I think most people misunderstand how money is used. I think not only people in crypto, but traditional, economists. Because I think when people think of money and they cite whatever definition, they think it's primarily used to purchase goods and services. And I can show you that that's actually incorrect. Take the U.S. dollar, U.S. GDP plus net exports, is $20 trillion, right? So roughly, the dollar should be traded for $20 trillion worth if it's being used for goods and services. Well, if you just count not stock exchange volume or purchases of bonds or houses, okay, just let's set that aside, but just look at the dollars trading on FX and derivatives markets and options markets, it's 100 times that 20 trillion. So for every dollar people use to buy a cup of coffee, it's used 100 times to speculate on the exchange value of the dollar. The dollar's primary use is to trade its value. So think about that. So if you look at crypto, yeah, Bitcoin's primary use, and this is our thesis, is to be speculating on the value of Bitcoin. And I also think that's going to be the primary use of Libra, is to speculate on the price of Bitcoin. In fact, oil is a commodity, right? So we buy, remember, there's actually 90% of all oil is bought by refiners. So oil's price is really set by the people who turn it into gasoline. For every dollar of oil that's bought and used by you to power your dinosaur car or fly on a plane, it's traded 30 times on speculation on price on a derivatives or a commodities exchange. Even oil as a commodity is primarily used to speculate on its price. I mean, everything that in the real world is speculation on price. Even if you buy a house, you decide to buy it because you think it's going to go up. No one buys a house thinking it's going to go down in value. Everything is about price.
Let's go to Libra. You brought it up. If the sole use case is to speculate on Bitcoin, I'm sure Mark is trying to argue something else in front of Congress, but what are the implications if Libra actually does launch? Implications if it doesn't? I know, Tom, you said it would be a bit of a setback if it didn't. What are your guys' thoughts on Libra as a whole?
So I was down in DC at their FinTech Week this week, and I got to talk to a bunch of central bankers, actually. And it's always funny, central bankers are actually pretty smart about crypto for the most part. They're all secretly studying it, like on the weekends, even if it's not really their job. And the reactions are really mixed. I mean, the people at the Fed, I think, generally speaking, are kind of warm to a corporate currency if the basket consists of dollars, because then it becomes essentially a strategic tool, for the advancement of U.S. policy, which is, exporting the dollar and making the dollar the numeraire of commerce. So if Libra does go the dollar-backed method, I think it would be very palatable to to Congress and to policymakers. However, if you talk to folks at the European Commission or other central banks, they find it to be quite hostile. Because if you are talking about going to their citizens on a direct-to-consumer basis, and we're talking about an American corporation filling their wallets with dollars as opposed to the local currency, you're implicitly, passively dollarizing these economies and removing the central bank discretion, which is super hostile. So my guess is many of these places wouldn't permit it to operate. But I don't think the US would permit it to launch if it doesn't have a vast majority of the supply being dollars. So I think that there's a bit of a paradox there, and it's kind of a rock and a hard place for them.
Mark, any thoughts there?
Yeah, I think how you choose the basket is really tough. So some have argued that maybe Libra should have started just with the dollar, kind of taking it off USDC, used all the same legal framework there, and then slowly expanded it. I think the basket is hard for people in the US because it includes other things, and then it's hard, like Nick said, especially for people abroad. And there's just no way around the fact that Facebook might include a certain currency of a certain country that they're trying to expand it more. And so I think it has a lot of kind of questionable political incentives, but it has a very kind of noble mission in that obviously it's, especially if part of that was Bitcoin, I think it would be incredibly interesting. I think for Bitcoin, the case really is, can it be a foreign reserve currency, or even a part of that? And you do have to get that right to get the speculation piece right. So I think that people are speculating on FX or on commodities or other things that do have some seed crystal of value to it, and then they just magnify it greatly in speculation. So I think you hopefully will see a parallel of Bitcoin being part of the global reserve currency, Bitcoin being a part of Libra. Like that's really the bull case for the space.
All right. Well, I'm going to cut it right here, but not because the panel's over, because I want to jump to questions from the audience. So if you do have any questions you want to ask, there's a mic on the left and on the right. Don't all jump at once. But we are going to take some questions from the panel per request to Compound. Does anyone want to jump in?
Do not hesitate. Jump in and ask a question.
Go for it. Whatever works, man. I think the mic could, yeah, here you go.
Nick, I think you mentioned that you didn't believe in the stock and flow analysis. Could you talk a little about why that's the case?
Yeah, this is going to get me excoriated on Bitcoin Twitter, but I'll go ahead anyway. So the stock-to-flow analysis is like the most popular model among Bitcoiners to explain the price gyrations, and the idea is that the value of Bitcoin is just a function of the inverse of the issuance rate. To me, this is absolutely preposterous. All of Bitcoin's supply was defined at inception. So there's no new information reaching the market when halving occurs. The halvings are known in advance. So, maybe people might argue that people will react to the halving because they expect other people to react to the halving, kind of like a recursive argument. That's fine. But fundamentally, no new information is reaching the world. The supply schedule was defined in January 2009. And it hasn't really changed. It's just proceeded according to schedule. So to me, modeling the value of Bitcoin according to its supply characteristics, which are fixed, is silly. You should model it according to the demand side of the equation. Like, who is likely to adopt Bitcoin? You assume that the supply is essentially invariant, and then you look to see, whether you think adoption is going to occur or not. Yeah, I just don't buy the theory behind the stock-to-flow analysis at all. And I'll add that in Econometrics 101, you learn to be very suspicious of charts that have super high correlation coefficients. It's pretty easy to make basically any model look right if you tweak it enough. So it's not compelling to me.
So rewinding a second ago to you guys' comment about using Bitcoin in kind of daily coffee transactions, for instance, I just have the question, does it really matter whether Bitcoin is ever used for microtransactions in a day-to-day basis in the economy, or wouldn't it, we don't use gold coins, for instance, right? But gold is still base money for the central banks of the world. So it would seem to me that that's almost kind of a fallacious sort of argument or sort of vanity metric for us to be worrying about, when in reality, if Bitcoin is base money, in the future, and when Moon, we get to the point where you don't actually need to transact with it on a day-to-day basis. Am I thinking about that wrong, or how do you guys think about that?
Yeah, I mean, I totally agree. I see Bitcoin as a high-powered settlement medium, eventually something that will be a auditable reserve sitting in a bunch of institutions. Maybe they'll issue Bitcoin IOUs or something, Bitcoin banknotes, based on the strength of their balance sheet, which consists of Bitcoins.
I think it needs to be used every day. I mean, gold. How many of you guys own gold? Can I just see? The rule of thumb, and I've been following markets for 27 years, is the price of gold is equal to the price of a good suit. I mean, so people think of gold in real world terms. And in fact, gold's price does approximate the price of a good suit. So, but yes, it doesn't have to actually be used, but I do think it has to be thought of as an everyday.
Sure, but I think the fetishization of micropayments, it harkens back to a time when we didn't really realize what was the interesting thing about cryptocurrencies. We just thought it was like a cool new alternative PayPal for the internet. I think we've learned a lot in the last 10 years. We can do a lot more with it than just reproduce some internet payment system that we already have.
So I'm Richard from Quantstamp, and I've been thinking a lot about negative interest rates. So in Europe and Japan, now there's a lot of part of the bond curve is in negative territory. So how do you think about, in terms of compound, the value proposition for those economies? And also in terms of, recently the Bank of China, they just announced they're going to do a digital central bank currency. So how do you think that's going to feed into the more decentralized options like compound?
Well, I think it definitely makes it more interesting for a really well thought out portfolio if the alternative is negative interest rates. Maybe at least people will spend a little bit more time thinking about what this asset is. So I think that's definitely something that's important. I would argue that within crypto, we really don't know what our own interest rate is either. So if you think about lending out Bitcoin and somebody borrowing it, you see quite a lot of difference between different centralized providers. So one thing we're trying to do at Tagomi is kind of standardize that a little bit and have a clearer match of people who want to lend and people who want to borrow and have a real risk-free rate in Bitcoin itself. So I think that is important. I think what's going on in decentralized finance is even more exciting and interesting because more people are participating in it, and it will have to compete with sort of centralized rates in crypto as well. So I think maybe the biggest thing really for us to solve is thinking within crypto, what is the cost to lend, what is the cost to borrow across all these assets. But from a macro perspective, certainly negative interest rates make an asset like Bitcoin an interesting prospect for a global reserve, or at least a fraction of a global reserve currency basket.
On the right, yeah.
Okay. I think this enough talk about Bitcoin. Let's talk about Ethereum.
Let's do it.
Okay. So I think one disparity I realized as an active market participant is almost all the Ethereum insider I know, including a wider DeFi crowd, is extremely bullish on Ethereum. And all of us has been screaming it's so undervalued every day. I mean, we are settling 90%, 99% of the stablecoin on Ethereum, almost all the tokenization happening on Ethereum. And in this year alone, I think we have seen more than 5 major enterprises announcing they are launching live settlement on Ethereum, like the SocGen settlement and some bond tokenization. But the price has not responded positively to all this major announcement. And even with the wider DeFi success this year, Ethereum hasn't really outperformed even the other altcoins as well. I think marginally, but not significantly. So, from you guys' perspective, you got to talk to the institutional investor. Why is this such disparity continue to exist despite all the information that's widely known to the industry insider? Yeah. And what's your view on this?
So I can take a stab at this. I think probably the biggest thing that people wonder about is the transition to 2.0. I know it's considered in Ethereum circles to be kind of fait accompli, already done. But I would say that their market is still pricing in considerable uncertainty as to whether it'll go through, since it's such a radical, change to the way that Ethereum works, and could potentially, and I'm not exactly an expert on this, but could potentially break some of the really interesting composability that we have in Ethereum already. So that would be one thing. The other thing I would say is, it's very hard to devise any sort of model to explain what Ethereum's value should be. I think there's a very compelling point to be made that some of these smart contract protocols will have lots of usage, but little to no value would accrue to the native unit without a compelling reason to explain where the reservation demand comes from for the token, it's the native token. Now, I think Ethereum has a case to be made for itself. In particular, the argument about velocity sinks, which is why we see so much emphasis on, value locked in DeFi, which I think is actually very positive for Ethereum because it is a potential story to explain where that long-term holder base would come from. But, we talk about how difficult it is to value and understand Bitcoin. I'd say Ethereum is much more complex and hence much more difficult. The last thing is, it hasn't really undergone the same process of financialization, which is a really serious boon to the price of Bitcoin because that just opens up the number and scope of entities that can own the asset. However, the CFTC has said, they're happy to have futures markets for Ethereum in the next 6 to 12 months. Those are the basic pieces of market infrastructure that need to be built, which allow normal or traditional entities to actually own the asset. So to me, it's uncertainty from the roadmap, hard to value, and some key pieces of infrastructure like custody and futures markets, which don't exist yet.
Or Nick, do you, do you think this is a factor? But I noticed that a lot of projects want to replace Ethereum. I think there's more capital being raised and trying to, instead of trying to make another Bitcoin now, it's trying to make another platform that's either for ICOs or tokens or smart contracts or, things that Ethereum does. So, I think maybe people perceive it's the Herfindahl index, the ability to sort of hold its share is less certain. What do you think?
I don't know. I'm actually pretty bearish on maybe all of the Ethereum killers. So I think they have this huge, I think Ethereum got a safe harbor from a regulatory perspective. In the wake of the Telegram negotiation with the SEC, it seems to me the signal is that there will probably not be other safe harbors granted, at least in the US. And the US is where a ton of this stuff happens, So that's one thing. That's a chasm they're going to have to cross somehow. And I don't know how they're going to, these new Ethereum killers are going to convince regulators that they're as decentralized or vibrant as Ethereum.
Regulatory and developer moat as well. Ethereum's in the lead there. I want to keep this going, but we do have to cut it short on the questions. I want to thank Nick, Tom, Mark, all of you guys for joining me. And we're going to move on to our next panel. I think we have a 5 or 10 minute break before they take over. So that's it. Thank you guys.